What do you think? What do you think of the discussion?
I think that people are too certain about things about which they should not be certain. I mean, the future is a closed book to begin with, and secondly, we are in a moment that literally has no precedent. Almost everything in finance has been seen before. What is new and different is the following. We have $8.5 trillion worth of securities priced to yield less than zero worldwide. At no point in the Treasury yield curve is an investor earning a return of greater than zero after inflation and taxes. Interest rates, by one measure in 2016 at the lows, were the lowest they had been in 400 or 500 years. So we are in an environment of extraordinarily accommodative, indeed, essentially free capital. We've been in an era of essentially free money for many years. Free money is lovely, but spending it, people will do things they wouldn't have done had that capital cost them something substantial. So, here's a vote, my vote, for a lack of certitude about the future. I mean, the National Weather Service, David, employs 4,200 people, has 76 billion meteorological observations a year, spends $1 billion doing it, and often misses a storm.
It does, although to be fair, it's gotten a lot better at predicting the weather over the last 20 years.
It has indeed, but notice the lack of improvement in the Federal Reserve's forecast. The future is not the Fed's best subject, nor is it humanity's best subject. And yet we sit around here listening to people telling us what's going to happen in March. Is it going to rain next Tuesday? So I would say that we don't know a lot. And in view of these circumstances, the most extraordinary circumstances of our credit markets or capital markets, we ought to be prepared for all manner of outcomes, many of which are unscripted.
Okay, well, Dick Kovacevic earlier saying the artificial increase in asset prices is due in part to what he would have not liked to have seen, which is the huge increase in the Fed's balance sheet, which is now being reduced. I assume you agree with these policies that are in place to try to create some sort of normalization?
Oh, yes, I think the Fed's balance sheet ought to be much smaller than it is. But having said that, I mean, yes, it would be lovely if we had rates that paid you something to invest in them. And it would be lovely if the Fed's balance sheet were not in need of a program of Weight Watchers. Well, that's good. But I think we ought not to underestimate the possible consequences of normalization.
Which are what?
Well, this economy is capitalized for ultra-low interest rates. The federal government's finances are set up for ultra-low interest rates. A 100 basis point cost in the federal borrowing is going to cost the taxpayers $160-odd billion a year. Private equity is capitalized for ultra-low rates, and on and on. So if we normalize, that's great, but we might have more days like yesterday rather than today.
All true, although, you know, you referred to this period as anomalous earlier when we were talking briefly. It's been, 10 years? I mean, you ostensibly write a newsletter that's intended to help people make money. You could have made the same argument, and probably did 10 years ago, Jim, and nobody's made a lot of money waiting for this readjustment you keep talking about.
Well, between the corners and in the interstices of the theme that we are on the wrong track, and there are all sorts of things to do, securities to buy and to sell, and we at Grants actually focus on those. But it seems to me there's nothing wrong with holding in the front of your mind, or at least not too far in the back of your mind, the fact that we live in this most extraordinary moment of monetary manipulation. Central banks the world over have commandeered financial markets in the interest of macroeconomic policy. The United States is not even the worst offender. The Japanese have destroyed its bond market. Their bond market. Mario Draghi has done almost the same in Europe.
We've been waiting for the Keynesian endpoint to be reached in Japan for many years now, and it hasn't seemed to come yet.
David, Japan is different. Anyway, so they were talking about inflation. And what will inflation be? A historical observation that inflation came upon us in the 60s on little cat's feet. The leading indicator of inflation in the early 60s was rates of inflation of less than 2%, often less than 1%. Succession, 4 or 5 years in the early 60s in which nothing happened in inflation. Then suddenly the world changed. Later they said that the historians, yes, the failed anchovy harvest off Peru, or the Federal Reserve's mismanagement of its interest rate during the Vietnam War, or a demographic shift. But I would observe that historically speaking, inflations or changes in the price level are often come as surprises. In fact, many things to us in markets come as surprises.
So do you think inflation increases from here? Do you think it's going to run hotter than everybody's expecting?
I think we live in an age of inflation, and that the likelihood is that we will have some sort of, that we will look back on this as a period in which inflation is building, and that one day inflation will be a ponderable number, say 4%. And this could happen in the next couple of years. And 4% in this environment would be a very disturbing thing. The highest point in the Fed yield curve at the moment, not the Fed's yield curve, but the highest point in the yield curve, I think, is now the London interbank offered rate, which is a non-official rate. It's like 2.8. And that is a cause for concern among people who, Dick was talking about how banks are under pressure. Well, to the extent that banks fund themselves at 2.8 and invest in securities yielding slightly more or even less than that, it's not the avenue to prosperity for the banking system. So a 4% inflation rate, which is certainly commonplace in our country in the past 30 years, would be a very big problem in this age of high leverage and extremely low, historically low nominal interest rates.